Okay, hello everyone. It's 7:01, so there's still more and more people joining by the minute, but I think we'll get started. And we are recording the session, so for those that are a little bit late or weren't able to make it, we'll send out an email to all of our requested attendees and others on our distribution list. I'm Michael McCloskey. It's my pleasure to welcome you to our second town hall. We received a lot of really positive feedback when we did the last one in the spring. We'll continue to do our annual meeting every year in the summer. But I think we're going to do this a couple times a year just to give clients and others the opportunity to ask us questions. And so I'm just going to share my screen. As I've indicated previously, it's being recorded. Your microphones are on mute for now. Later on in the presentation, there's going to be an opportunity for people to ask questions. My colleague Michael Leban and Loon and I are going to talk for 15 or 20 minutes. And then we really want to open it up. We've already received a number of questions that we'll try and address in the set presentation. If you want to ask a question at any time, you can email Michael and I in the chat. If you go to the bottom of your screen, there should be a tool that says React or chat. And if you click on that, you can put up your hand, you can send us a message. And again, towards the end, we'll also open it up to video if people would rather ask questions that way. So with that, bear with me, and I'm going to share my screen with you and get started. Okay, hopefully, Michael, you can see the screen okay?
Yep, you're good.
Okay. So we had about 45 people sign up for this, and I'd say about half are current clients, the other half are potential clients. I don't want to go through the whole GreensKeeper commercial today. I want to spend more time talking about our portfolios, what we're seeing in the market. For people that aren't familiar with the firm and are interested in having a one-on-one afterwards, I'm happy to set up a call with you. Just message me, and I'm happy to answer your questions about how we invest at a more granular level. But today I want to stay at a pretty high level and just give you an idea of what we're doing with the portfolio and what we're seeing in the market. So very briefly, the firm was founded about 14 years ago. I launched the value fund in 2011, and really we just started with 3 million in assets under management. It was my mom and dad, my brother and sister, and then some friends had indicated an interest in having me manage their money as well. So I created GreensKeeper as a vehicle for others that wanted to invest their money alongside how I wanted to do it, which is following the time-tested, value-invested methodology of our heroes, Warren Buffett, Charlie Munger, Phil Fisher, and Ben Graham. And we've grown from there. As you can see, this is a chart showing our assets under management. We only offered the value fund as our only product until about 2019. And then after 8 years, I got tired of turning away business. So I started also accepting separately managed accounts where people outside of Canada perhaps couldn't invest in the fund for tax reasons. So we did that in 2019. And as you can tell from this slide, we saw quite a bit of a growth spurt then. I was approached by people in Quebec, so we expanded our registration there. We went through 100 million in assets under management in 23. And this year, we've expanded our registration to Alberta. Again, we've received inquiries, so we've expanded it. And just recently, we've registered with the SEC in the United States. And, I think what makes our firm different, I'm one of the biggest clients of the firm, so I'm going to manage my money and clients' money the way I think it should be done, the way it's taught by our heroes. And as I talked to the team about, they believe in our mission, and every single one of them has invested their money alongside our clients as well of their own volition. There was no pressure on me. Michael Van Loon, you've heard from him before. He joined us as a summer student in 2022 as part of our summer program. He then went back and finished his IB HBA at Western and joined us full time just over 2 years ago. He's passed CFA level 1 and 2. He's going to write the CFA level 3 next year, at which point he should be licensed as a full port manager full portfolio manager. He's currently an associate PM. And we have big plans for Michael, and you're going to hear from him today. My brother James, as many of you know, is the human magnet. He does a great job of telling people about me and the firm and what we're doing and bringing us some clients. And the clients on on the phone or on the video would know Michelle. She's been with us since 2017. So she handles all client inquiries and statements, and if clients need money transferred or their RSP contributions or RIF withdrawals, she does a great job. In addition, she runs my life and helps with compliance. And this is our core team, and I expect the team will stay small. But what you don't see here is there are other people that have helped us get to where we are. My sister Jacqueline has been consulting with the firm for 2 years on pretty much a full-time basis. We hire high-quality third-party service providers. We have a fund administrator, auditors, legal counsel. So my philosophy is I want Michael and I to spend our time managing money and not people. And so the core team will, I think our assets under management hopefully are going to continue to grow if we do a good job for our clients. But the team will remain fairly tight knit. And this is our mission. I talk to the team all the time about this. We have one goal, and that's to make money for our clients, including us, while protecting their capital. And when I look at the market environment today, I had a lot of questions from people as they registered saying, what do you think about the market? And so the second part of this statement, I want to make all our clients money, but I also want to protect their capital. That second part of it is where we've been focusing our time over the last few months, and I think you'll understand why very shortly. Warren Buffett rarely comments on market valuations. He's done it twice, quite specifically. And the first time was in 2001. There was a Fortune article that he put out, and his comment in the article was he called this metric probably the best single measure of where valuations are at any one given time. And this is a measure of the U.S. Market capitalization of all the public companies divided by the size of the U.S. economy, or GDP. And so you're trying to figure out what are the public companies worth relative to the size of the U.S. economy, and that was his yardstick. And his quote at the time, again in 2001, is if the percentage falls into the 95 to 100% area, which is about here, buying stocks is likely going to work out for you. But if the ratio approaches 150%, like it did in the time he wrote the article, he said you're playing with fire. And well, today we're at 223%. So, it tells you where I think using that metric, where he would think, he hasn't commented on specifically, but somebody else asked me before the call, he said, what do you think of Warren sitting on $360 or $380 billion of cash? And what I think is he doesn't like talking about the market, but he's telling you through his action, he's not finding intelligent things to do. And he's stepping down as CEO, but that's not the reason that he's accumulating cash. He was asked at the annual meeting this year in Omaha, are you leaving Greg Abel, the Canadian who's going to take over as CEO on January 1? Are you leaving him the cash so he has dry powder and a clean slate? And Warren's comment was a little self-deprecating. Said, "I'm nowhere near that honorable or humble. If I find something to do, I'm going to put it to work." He's not finding anything to do. Is really the lesson I want to get across here. Some of you might be familiar with Michael Burry of the Big Short fame. He ran a company called Scion Capital that he just closed down in the last month or so. And he sold all of his stocks recently, and he put on two shorts. The first one was NVIDIA, and the second was a defense AI company called Palantir. And, he's pretty visible, so people paid a lot of attention. And the CEO of Palantir was obviously none too pleased. No CEOs when a high-profile person is shorting your stock. Here's a chart of the Palantir stock price. And Alex Karp, the CEO, went on CNBC, I think it was, and said the idea that you want to short NVIDIA and Palantir, if that's what you want to short, that's batshit crazy. And, I don't know if that's a crazy bet or not, but Palantir is trading at 71 times revenue, not earnings, revenue, and over 200 times earnings. It's growing fast. It looks like a really good business, but I think this bet could work out for Michael Burry. I don't think it's crazy. I was asked a question, what are our thoughts on short selling? We don't short at GreensKeeper, and there's a couple reasons. And the first is, with shorting, it's an asymmetric bet. The most you can make is 100% of your money. but you can lose an infinite amount of money if the stock keeps going higher and higher and higher. And what I've learned is that, a stock that is priced at 75 times revenue can go to 150 times revenue very quickly, especially in the meme stock era. So you have to be right, but you also have to get the timing right. And there's a cost to shorting. So that's one of the reasons we don't do it. The second reason is I think it's really important that you marry your investment style with your personality. And to be a short seller, you have to be, I'm contrarian, but I don't like to be confrontational. You almost have to be confrontational to be a short seller. Everybody hates you. The company hates you. The people that are long the stock, that own the stock, they don't want people bad mouthing it. They want the stock to go higher. So, it's not a fun existence, and you can read about a lot of short sellers. I just think my life would be more miserable if we were involved in short selling. And finally, it's just hard. I haven't seen many people be able to do it successfully over the long term. So I think being long is more suited to our personality, or my personality at least, and the way I want to spend my time and invest. And finally, I was asked a question about, are we in an AI bubble? And I guess OpenAI is kind of the poster child. So Sam Altman, it's a private company, but it's got a very, very high valuation. And one of his supporters, Brad Gerstner, he's a venture capitalist. He's also a shareholder of OpenAI. So he's a fan. And he asked Sam a question on TV and said, how can your company, OpenAI, with 13 billion of revenue, make $1.4 trillion in spending commitments? And Sam's response was a little flippant and a little arrogant. He says, "Look, Brad, if you're not happy, I'll find someone else to buy your stock." He didn't answer the question. And so I guess what I'm saying is, Michael and I spend all day researching what stocks are doing in the market and AI, and we see a lot of frothiness in certain areas. In particular, it is definitely getting harder to find things to do as a long only manager and as a value manager. But I think there's a smarter way to, AI is here to stay. It is changing the world. We use it every day. I love the product. I think there's a smarter way to play it, and that's through Google. And, I think the world's finally woken up to the fact that Google, I believe, will survive the threat of OpenAI. And, they seem to be a market favorite, at least over the last few weeks. So Michael's going to talk a little bit about our holding in Google and our thesis on that one. And so when the market's really, really expensive and frothy, I go back to a famous French value manager who once said, "I'd rather lose half our clients than lose half our clients' money." As I said earlier, I'm one of the biggest clients of the firm, and it's more important to me to invest properly and to protect clients' capital when I see things getting a little bit stupid. And so there are going to be times where we're at a step with the market. And I would argue that this is one of those years, and I'll talk about our results shortly. So, at times like this, Michael and I have been doing things. We've been trimming positions. We've sold out of positions entirely because I thought that they were more than fully valued. And again, there was a risk that either the economy rolls over or that these stocks re-rate. So we're fairly defensive at this point in time. If I go back over our 14-year history, someone who invested with us from day one, $1 million would be at about 3.6 million today. It's compounding of 9.6%, net of all fees and expenses. And we've been positive in 13 of 14 of our full years in existence. As of the end of October, we were down 1.2%. Michael and I are pretty competitive. We're trying to get that positive for the year. And as of today, we're just a hair into the green. But preservation of capital is kind of where our mindset is, given where things are in the market today. And this is the portfolio as at the end of October. The chart on the left shows you we at the end of last month, we had about 70% of our equities for companies based in the US, about 26% in Europe and the Middle East. And that's a big shift over the last 2 years. And primarily, it's not because we wanted to divest from the US, or we go to where we're finding value anywhere in the West, any country that respects the rule of law. We're finding more value in Europe, which is why we've made the pivot, and we put some money into companies in France and Switzerland. We hold a little bit of cash at the end of last month and one small Canadian company. Now, this is at the end of last month. Since then, we've increased our cash position in the fund to about 12.5%. So we've been trimming and getting even more defensive than when we were even 3 weeks ago. the bar chart on the right just shows you the sectors that we own. We like technology. Buffett and Munger tend to stay away from it, but we're not them and we're not in our 90s. So we embrace technology, and we'll talk about some of the companies that we own. We're trying to build a portfolio of 17 to 20 stocks approximately, where there's enough diversification, but where it meets all the rest of our criteria: good management, excellent business, lots of free cash flow, good balance sheet, and at an attractive price, which has really been the hard one over the last year or so. And so these are our top 10 holdings as of the end of last month. And clients will be familiar with, I'd say, pretty much all of them, because we tend to hold our names for a long period of time. And so, over time, we talk about them and what we're thinking. Alphabet at the end of last month had crept up to almost a 13% weight, mostly just due to performance. And that's been one of the names that we've trimmed recently. One of the things I'd mention is that we tend to hold stocks for a long time, which means if you look at the column on the far right, the unrealized gain and loss, all of them except for Icon are in a gain position, and some of them quite materially. And so we love investing in businesses that are compounders. These are companies that continually grow their earnings. They buy back their own stock. They pay dividends. And if we buy it at an attractive price, our job is really just to monitor and let them compound, because our job is really to get that unrealized gain as high as possible without realizing it. We want to let these stocks run for years and years and years so that our clients don't have to pay tax, and yet the value of their investments continues to increase. Okay, and so finally, before I turn it over, so this is a snapshot at the end of last month. As I indicated earlier, our portfolio at that time was down about 1.2%. Our contributors are the ones at the top. Our detractors are the ones in red. Our biggest contributor was Alphabet, and Michael is going to talk about that momentarily. And then our biggest detractor was Fiserv. So I have the pleasure of telling you, why it costs us 5% year to date, and what we think about the company today. So with that, I'll turn it over to my analyst and research colleague, Michael Van Loon.
Hello, everyone. As Michael mentioned, today I'm going to discuss our top performer year to date. Also, one of the value fund's longest tenured holdings, Alphabet, which is the parent company of Google. And recently, sentiment around Alphabet has been heavily influenced by the developments in the artificial intelligence space. And over the past 2 years, ChatGPT, or OpenAI, has really captured much of the media's narrative, causing a lot of the market to think that Google search was effectively a dying business. And this caused Alphabet's stock to really be classified as a large AI loser, according to a lot of the financial press, as you can see with the headlines on the left-hand side of the slide here. And we disagreed with that characterization, as we have long believed that Alphabet's ability to attract top technical talent, the roughly $120 billion in operating cash that they generate each year, and its massive distribution footprint would really give it an advantage in bringing AI products to the market at scale. And early signs suggest that the company is navigating the transition to AI quite effectively, as Gemini, their main AI product, now has 650 million active users, which is up from just 450 million active users at the end of the second quarter. And most importantly for us as shareholders, search revenue growth continues to grow and is actually accelerating, which has been partially attributed to Google being able to monetize its AI products at a very similar rate to its traditional search business. After Alphabet's launch of Gemini 3 model last week, along with a very strong earnings report in October and a relatively favorable ruling on its search antitrust case back in September, concerns that AI will disrupt and that narrative will disrupt Google's business model have really reduced, and now the media headlines are catching up to the stock price, which has been up 100% since the lows back in April earlier this year. And at GreensKeeper, we first bought shares in Alphabet back in 2018, and since our initial investment, Alphabet's earnings, as you can see on the left-hand side here, have grown at about 23% per year, and now the stock price has increased by about the same amount. And we don't think that the correlation between Alphabet's earnings growth and share price growth over our investment period is much of a coincidence. And that's because we really believe that the long term, in the long term, a company's share price should converge with its sustainable earnings power, which we can see for Alphabet has been increasing steadily over time. But even businesses as strong as Alphabet, they can be quite volatile, or their share prices can be quite volatile in the short term, which can cause their share prices to significantly lag the underlying earnings growth for a period of time. And in the 7 years that we've owned the company, its stock has experienced drawdowns greater than 20% on 5 separate occasions, as you can see on the chart in the right-hand side there, the shaded areas, with the largest being that 44% drawdown that lasted for nearly a year back in 2022. And we really tried to use this short-term price volatility to our advantage, and we've increased the size of our position in 3 of the 5 largest drawdowns, as we've been quite confident in the company's fundamental growth opportunities. And if you look back to the chart on the left there, you can see that the bulk of the rise this year in Alphabet's stock price has really been a result of the gap between its earnings growth over the past few years and the share price narrowing from the historically wide discrepancy that began back in 2022 when AI models first started to gain a lot of the market's attention. And going forward, we believe that Alphabet remains in a very strong position to continue growing its earnings at attractive rates. And that is really what we spend the bulk of our time at GreensKeeper trying to predict, as over a long period of time, it should result in strong shareholder returns, as we have seen with our Alphabet position throughout the year. Now I'm going to hand things back to Michael to discuss Fiserv, another one of our value fund holdings.
Yeah, and this one's been a stinker this year. There's no doubt about it. If you look at the chart on the left, the blue bars show the company's adjusted earnings per share since 2009, so over 15 plus years. The line is the revenue. This looked like a compounder to us, and and to the market. And as you can see in the stock price on the bottom right here, the stock collapsed starting in about March or April. So at around that time, we'd owned the stock for a few years. We were quite familiar with it. I know a lot about payments, and we were geniuses. We were up 130% on our position, and then today we're probably down about 30%. And so what happened? And the gist of it is a new CEO came in. The former CEO left to join the Trump administration, I think about 6 or 8 months ago. The new CEO is getting his arms around the business. This was, I believe, his second conference call as CEO. And he came out and said, I know management has told you certain things in the past, but we're going to give you a more holistic view of what's been happening with our business. In other words, these are my words. I think we're going to tell you the full truth. And they effectively walked the former CFO to the door. And the new CEO said, listen, we've previously given you some information about Argentina. Argentina, they had a portion of their business there. They only disclosed certain metrics historically, but Argentina has been going through hyperinflation. So that can skew results. And what the new CEO said was, well, remember how we gave you these growth figures? Well, the real number is about 10% lower. So, that's not good. The second thing he said is our former management was really focused on short-term quarterly results. So if they needed a little bit more revenue, they're adding junk fees, is what we call them, to customers who weren't getting much value for them. And in effect, they were losing customers. They were dropping off of their platform because of these fees. And finally, the third thing, they suggested that historically the company hadn't been reinvesting in the business as much as they should have in software and systems, because again, they didn't want to incur the expense. But if you do that for too long, it starts to harm the business and your customers. So I think the new management team is doing the right things. I hope they're being honest with us about what's actually going on. But there's no doubt about it that the underlying growth rate of the business was being skewed by some of these things in the past. And so our calculation of the intrinsic value of the business is lower than it was. Now, where the stock is trading today, we did a complete underwrite of the security. We said, we're going to go back. Would we buy it today if we didn't own it? What do we like? What do we not like? What what could we have found out what actually happened historically? And one of the questions I got from somebody was, what do you learn from your mistakes? And so this is a perfect example. And as Charlie Munger would say, I'm trying to rub my nose in my mistakes so I don't repeat them. The conclusion we came to is, I don't know that we would have been able to figure it out just based on management's numbers, because they didn't provide us with enough data to show what was actually going on in Argentina and underlying in the business. But one of the things I take away is I've been in this business a long time. I'm pretty skeptical. You can't really trust what a management team says and what an analyst says. You have to do your own work, and we did do our own work. But subsequently talking to some fellow value investors who made the same mistake, we compared notes, and I think the only thing I would do differently was maybe do a little more scuttlebutt, potentially talking to former employees to see what's going on under the hood. But it's been a tough one, and in the top right, there's a website I go to called Dataroma, and it's a list of, I don't know, 40, 50, 60 really high quality value investors primarily. They call them super investors. Last quarter, Fiserv was the top stock that was added to the portfolio. So the numbers sang to me, and I think sang to others, because the stock looked cheap, and obviously there was more going on behind the business. So you try and learn from these things, and as I said, you try and you don't ignore it. You got to take your lumps, and I want to be transparent about it. And it's been a tough one, but our view is we're not increasing our position. Given the lower growth rate, there is a price at which we're prepared to sell it, and we're going to wait for our price. I think selling it here, the stock's still trading at a 12% free cash flow yield. I think next year is probably going to be a little bit tougher than this one, but we're watching it. I'm going to remain skeptical. But today I think it's about a 2.5% position in the firm. So I'm going to open it up to questions momentarily, but there were a few more questions that I couldn't weave into the conversations. I'll start with those. What's our exposure to tariffs, and what's the short and long-term impact to performance? The way I'd answer it is we look at tariffs company by company. And so every company in our portfolio, every company we're looking at, we're going to think about how will tariffs impact them? Do they have pricing power that they can offset it? Are there certain things specific to the business that they can do to mitigate tariffs? Or are the tariffs fully priced in, where even with the tariffs, the stock is too cheap? That at a high level, that's how we look at it. But then you go a level further, and I'll give an example of the pharmaceutical industry. So the Trump administration has been threatening drug manufacturers who make a lot of things outside of North America, saying, the US has been subsidizing the rest of the world when it comes to drugs. And you know what? That's actually true. When you look at what Americans pay for drugs relative to Canada or Europe, they pay way more. And the problem is, so if you're a drug manufacturer, we own some drug companies, what do you do to mitigate? First thing, you have some manufacturing in North America, and you try and produce as much as you can there for the domestic market so that a tariff doesn't apply. That's the first level of analysis. The second thing you can do is you can stockpile. If I have to import it, well, I know the tariff is coming. I'm going to import as much as I can, as long as they'll last long enough on the shelf to try and mitigate that tariff impact. But the bigger picture analysis for us on pharmaceuticals was, even though the administration might be right and you want to get the US drug prices down, you're going to have to get drug prices up elsewhere if you want to keep the profit pool and keep the profitability of American pharmaceutical companies. And I think that's an underlying goal. And the drug lobby is very, very strong in the US. They pay a lot of money to politicians. So our view was the only way to actually do it was to do it over time. Canada and Europe have agreements for existing drugs and how much they're going to pay over the next so many years. They're not just going to say, okay, sure, charge us more. The only way this is going to happen is when a new drug comes out, we're going to charge the American consumer less, and we're going to charge the ex-US consumer more. And over time, they're going to have to balance that. And that seems to be the way it's playing out. I mean, every day is different, but that's how we think about tariffs and as we do stock analysis. The second question is, if the AI bubble bursts, assuming there is a bubble, where would you see value opportunities? And that's the funny thing about when it happens, or if it happens, whether it's an AI bubble or a war, something will happen. There will be another stock market panic. I don't know when. I don't know what the cause will be. It could be the AI bubble bursting. As I say to Michael all the time, you don't know what the cause will be. You don't know when it'll be. But when it happens, you have to be ready because it happens fast. It happened in '08, happened in 2000, March 2000, it happened in, during COVID, March of 2020. So we spend our day updating our watch list and our stock prices at which we think it would be interesting. And when something happens, I say to Michael all the time, it happens fast. We're going to get 20 emails saying this stock's at your target price, this one. And so very quickly, you have to update our models and think about, okay, we're given whatever's happened and whatever that impact is, short or long term, what is our best opportunity set for redeploying capital or selling something that we think is less attractive. So I don't know where the value opportunities will come from. All I know is we're doing our work and building our list to get an opportunity to buy these great companies if we get our price. And so I hope we do. And the final set question was our update on Richemont Thesis. And Richemont is it's a top 10 holding. It's up about, I think, 70% since we bought it a few years ago. Richemont is the largest branded jewelry manufacturer in the world. They own the Cartier brand. It's a over 100-year-old French famous jewelry brand. They own Van Cleef and Arpels and a few other branded jewelry brands. The business continues to perform very, very well on the branded jewelry side. Margins are good. Sales have held up quite well, despite the Chinese consumer being a big part of their sales historically. They're starting to spend again. Wealthy consumers are starting to spend again. The second segment of the business is watches, high-end watches, and that's been a little tougher, especially with the Chinese consumer not spending as much. Asia is a big portion of that sales, but to us, it's an okay business. It's not the best part of what Richemont is all about. And then the third segment is smaller niche brands like Peter Millar or Montblanc Pen Company. That's a break-even segment. It doesn't make any money. It doesn't generate a lot of revenue. We bought Richemont primarily for its branded jewelry. It's the best in the world. It's the biggest in the world. I think LVMH would buy the business in a second if it were for sale. The company still runs it like a long-term owner. It's family controlled by Johann Rupert. I think 5 billion of cash on the balance sheet, no debt. So we love the business, and there's really no change. I hope you see it in the portfolio years from now, as long as our thesis continues that wealthy people will continue to want to show, project their affluence. I think Richemont should be a company for many, many years. So with that, I'm going to stop sharing my screen and I'm going to open it up to questions. Bear with me for just 1 second. Again, you can either put up your hand, just bear with me. So at the bottom of your screen, there is a chat button. If you click on that, you can send us a question. Or if you, also there's a react button. If you put up your hand, I can start your video and take your question over video if you'd prefer. So just bear with me. Let me allow people to unmute themselves. With that, I'm happy to take your questions. So again, if you have a question, put up your hand. If not, I'm happy to wrap up, and I want to be mindful of people's time. We have recorded the session. We will post it along with the presentation online in the coming days, and everybody on this call and all registries will get a copy. As I said a little bit earlier, we're quite cautious in this environment. Buffett once said, it's be greedy when others are fearful, and fearful when others are greedy. We're just seeing a lot of risk taking in this market, and we have tried to be very judicious at where we're putting capital to work. We've trimmed stocks that we think are fully valued, and we're biding our time. Much like Buffett or Michael Burry, I think we're going to get an opportunity in the next couple of years. Could be next week, it could be next year. I don't know. Where I think at least some of the stocks on our watch list are going to come to within our strike zone. I don't know what the trigger will be. But I don't love lagging the market in a year like this where everybody's making money. But we're going to continue to manage the portfolio prudently. And if that means missing out a little bit on the upside, historically, we have always been at our best when markets have been at their worst. And I think that's a function of we buy stocks cheap, we buy high quality businesses with good balance sheets. And if you do that consistently over time, those are the kind of companies that survive downturns. They take out smaller competitors. They gain market share in downturns. So, we're going to, now that said, I'm happy to wake up tomorrow and put money to work if we find something to do, no matter what we think the economy is doing or the stock market's doing. It's really a function of finding our price and meeting the rest of our criteria. And so as a value investor, we're going to stay patient, stay disciplined, and continue doing what we've done for the last 14 plus years. And it's done us well, and I think it will continue to do as well. So if there are no questions, I want to thank everyone for attending, and I look forward to giving you another update in the new year. Have a good evening, everyone. Thank you.